Okay, so going on through list three, leverage selection. Am I sure I want to magnify this trade? If so, how much do I really want to magnify it? Am I comfortable with my downside? Am I playing within my dojo belt level? So let's go back to the storage trade, right? Great example of if we set our long down here, we would have lost nothing. If we set our short up here, we really can't guarantee that we're going to succeed. Great example of how even the 5-minute is not really dependable, right? Because here's another perspective that could show you that this bar could easily just be volatility, right? If we look at the 12-minute or the 15-minute and we kind of see what's going on for what it really is, that bar, and this is what I like to do, I like to hide, this bar, which I like to refer to as pressure or emotion, really hasn't sustainably breached that, right? After all, even the 15-minute is still down here, and it's loose bullish, but it could easily come back down, retrace to here, do a bullish retest, and then move back up. Because, again, we are overextended factually from the 2-hour and the 4-hour movement monitors, right? They might have moved up a little bit since then, but like I doubt if they're much higher. And so chances are that that price action is likely to come back down. So this is a great candle that serves to kind of say, hey, this is the kind that people chase. This is where people think, oh man, I was wrong. I better jump in. It's going to go to the moon. And it's not necessarily the case, because when you simply look at where the statistical averages of price action for this tiny time frame, it's saying, dude, we're still like below that by quite a bit. And orange, in fact, has faded to green. So there's no guarantee that we're going to any kind of moon, right? So be cautious of that. And when you remove the price action, you kind of remove the emotion. Now I can look at it for what it really is. Price action is about here, right? To the trained eye. To the untrained eye, price action is like way up there, faking people out, being crazy, just being volatile. Now, could this work? Because a pressure line, sometimes works pretty well, or a pressure line zone. Yeah, look at that. I mean, it worked great, right? Within a third of a point. Like that is what pressure lines do. But at the same time, man, the volatility on these things has wicked me out like crazy. And so it definitely, to me, makes sense just to wait and to be patient and wait for confirmation of, 5, 10, 15, 24-minute time frames to show me that there's some degree of like real longevity that we're going to blast through, this little area. Because if there's no movement monitor in any even micro scalping time frames that have passed that yellow line, then that price action is almost like an illusion, right? And so there's a good chance like we could still get a rejection, go right back down to our original trade, our serious trade entry. This is more like a FOMO trade, right? Like, oh, I just want to be a part of it. I might as well make some money here too. But it's such a great way to lose money, is just thinking that you have to be a part of everything. The pre-planning and the premeditation of an intelligent trade is really where more money will be made. Also, being a part of a trade based on the 2-hour or the 4-hour is where much more money will be made, given the same exact leverage, relative to trying to be a part of a trade on the 5-minute time frame. You can be successful at both. You could try both. You could use leverage on both, but it's dangerous, right? So great example of, using the 5-minute volatility cloud may not be wise. Using pressure lines alone to short something, especially in an upward sloping channel like this, may not be wise. Great example of how just because price action breached that yellow pressure line doesn't mean that like, oh, we should instantly go into a long. It's going to hit all of our targets. Absolutely not. And I think it's a great example of how just a few small time frame pressure lines can serve to give you a realistic perspective on where price action really is when you strip the emotion. How do you strip the emotion? You just go here, You hide the candles. Now the emotion's gone. Should I be bullish in the 10-minute? Yes. Loose bullish? Yes. Is it probably weakening? Yes. Where's like the average real price? Probably right around here. I don't even have to look at the charts with candles on them to know these things, right? This is where the fair value of storage should be in the 5-minute time frame. So if I look at the chart and it happens to be way up here, then it's overpriced and it's probably going to come back down, because the reality is the fair value is just somewhere down here. Even if I turned it on and I saw the price action was here, fair value is probably going to be somewhere in here, even if it drags that line up, right? And each little tiny little tick on that line takes 10 minutes to happen. So you really have to kind of get a grasp on time relative to price action. And 100% do not let it sway your emotions, too greatly. Okay, so we're gonna continue and see what we can do. Will it affect? We've already talked about, will it affect me emotionally? Leverage. Am I comfortable with the leverage? So, I mean, as far as leverage goes, that 5-minute was a great example, right? If I was gonna do it, might be a good idea to use this pressure line as a backup instead of the 5-minute volatility cloud. If I wanted to do it, might even be a good idea to try to use this pressure line and see what happens. But if I were to do it, I have to look at just a couple things. I have to look at this to make sure it's at least above 5 or 6, at least, for it just to make sense. I have to look at this. When I put my real numbers to it, what kind of return would be worth it to me to enter the trade, right? This times what? Times 3? Times 3, what would that be? Almost 9%? I don't know. That could, depending on your initial capital, that could be worth it, right? What would this have to be in order for me to feel safe, right? I'm willing to lose, 3% on this trade? This isn't even the trade I want. This is going against the trend. So some people would say, I'm just not going to do it. But if I had to do it, if I had to choose numbers to do it, then it's a question of this times what am I willing to comfortably lose? And then once I have that number and I say, well, probably 10x, pretty easily, right? I'm willing to lose 3%, 2.3 plus slippage. I'm willing to lose 3.5%. That's fine. Let's do it. So $1,000 times 10x. Then I have to go, should I actually consider reducing the organic capital at risk? Should I consider bringing it from 1,000 to 500 because I'm going against a few things that I shouldn't? I'm going against a green cloud. I'm going against an orange and green movement monitor, right? If that's what you're seeing in different time frames, and even in small time frames, consider that, right? So should I reduce my organic capital at risk, what I have in the position, real cash, and should I reduce my stop loss, what I'm comfortable doing here? And so consider the reductions, right? And leverage magnification and stop loss amount are two of them. And then also organic capital, how much do I actually have in the position, is one of them, right? So if we open this up, we can see price action is back toward our statistical average, right? Somewhere in there. And that's why they call these things moving averages, because when price action deviates from them, so much, it doesn't make sense to FOMO into them. Even on the 1 day, right? Why would I FOMO into price action that's deviated so much to my disadvantage, right? And so when we have all this data on different time frames, we know when things are overextended and when we should consider doing something different. So in this case, I might say, okay, you know what? This one hasn't turned blue. Oh, there's a blue right there. But overall, there was no blue in this large uptick. So being that for this to go blue, it would have to deviate quite a bit. I'll set an alarm and I'll see where it is when it goes blue, right? So to set an alarm, I just literally take that. I go, I'm going to add an alert. I want to do bear condition. This is a fast trade, right? So ping me once per minute. And then I would be bearish storage short, right? And then I could literally just copy and paste it. So when that message shows up on my phone as a banner, my email, wherever it goes, it shows up as that. And then I just go, do I want to enter a bearish storage short? And guess what? If it happens to ping me here, I have to ask myself, some of those questions again with regard to asymmetry. I've made up my mind that it's going to go there, but maybe I have to ask myself those questions again relative to asymmetry. And I look for what makes sense, right? At least 8% risk reward ratio. At least, this take profit zone or this take profit zone. Is that still possible? Let me double check the 2 hour and the 4 hour. And I reevaluate my asymmetry, right? With still the larger scale expectation of looking for a trade, the real trade, to be this one, right? Based on the data as we had looked at it. Okay, so those are some things to consider. That's the leverage selection. Am I sure I want to magnify the losses on this trade based on the asymmetry calculator? That 0.23%. By how much am I willing to magnify that? Knowing, especially, that I'm going against the trend, right? So maybe based on what I would normally do, I'm going to just do 50 or 75% of that. If I would normally do 10x and I'd lose 2.5%, why don't I just not be greedy and just do 5x, right? If I would normally do 20x, maybe I'll just not be greedy, know that I'm going against some of my rules on my checklist, so I'll do half of that. Am I comfortable with the downside? Am I playing within my dojo belt level? And that's a simple way of saying, have I tested myself with this leverage such that I know I consistently win 1 out of every 5 times? I at least have a 20% success rate. And technically, if you don't have a 20% success rate in the leverage that you're playing with, then you should probably not be doing it, right? You should find that level that you can succeed with at least 20% of the time and then move up from there, right? So what I always kind of tell myself through my own lessons is 1 to 10x is responsible for a good trader, right? So if you have that kind of experience that you consider yourself pretty good, 1 to 10x is generally responsible. Then I like to tell myself 10x to 25x is the tuition zone. You will lose money there, and if you're really good and you find yourself successful at it, hopefully you get to where you know your win rate and you know when it makes sense to do something or when you should just stay out of that zone because you lose too much. And I like to call that the tuition zone because you'll pay a lot, just like college, and you'll learn a lot of lessons. So it's a great zone that can help you with personal development. It can cost you a lot. And at the same time, you'll definitely learn a lot of lessons about yourself, about trading. You'll know whether you belong there or not. Some people will stay there and find a home there, and they'll be comfortable there. They'll just use asymmetry and some of these rules to make sure they do well. And some people will say, I don't belong here. I lose money when I play here. I make more than enough money trading 10x or below. And so I'm going to stay there. And I'm going to trade larger amounts of capital so I can feel better about my absolute value behind my ROI or my stop losses or whatever. You don't need a ton of leverage when you have more capital. I'm not suggesting anybody put in more capital than is prudent or smart or wise. I'm not suggesting a percentage of net worth anybody puts in. That's up to the individual. We all have our own, opinion of what we want to put in any given place. I would say if you put money into the space in general, really any space, it's wise to kind of diversify, right? If I had $10,000 to put into, crazy places for financial trading, I might put some into, if I'm good at it, I might put some into, options trading in the traditional finance world. I might put some into a few exchanges, different exchanges in the crypto world to kind of protect myself from risk of collapse of the exchange or hacks or whatever. If I was good at it, I might consider putting $1,000 into DeFi. I might even separate, those funds with different wallets. So there's just a lot of different places, you can put money, and diversification across mediums and platforms is not a bad thing, just because if one collapses or gets hacked or has a problem, you have 9 other places that you put 9 other $1,000, and so you only lost 1,000 out of your 10. So going back to what we were talking about, 25x, 10x to 25x is your tuition zone, and then I like to call 25x plus the donation zone. Let's keep it uniform. So donation zone, right? Because that is usually where you're giving money to the market and you're donating. Again, if somebody finds that that is within their belt level and they consistently do well and they're profitable and they've done it for months in a row, great. I don't want to talk anybody like that out of it. But most people, that is the donation zone. And so I'm going to call 1 to 10x the responsibility zone. Again, assuming that you are a responsible trader. I'm gonna change the wording on here. Right, that way nobody gets it twisted here. So 1 to 10x is a responsibility zone for an intelligent and sophisticated trader. 10x to 25x is the tuition zone, probably still for an intelligent and sophisticated trader. 25x is likely the donation zone for most traders. Let's okay, got it.